Hey Martin, this is a really great question. I'm looking forward to going through it because this will help a lot of people understand how the tax-free component and the taxable component works, and also strategies that financial planners put together for clients all the time. And this is something we do with clients all the time. It is a very complex strategy, so you should reach out to a financial planner to make sure you get this quite right. There's a lot more considerations than just my response here. Some other considerations are, can my super fund get this done? Generally speaking, super funds don't understand this, or the consultants at super funds. You need a financial planner to guide you through this. But I'll flip it over and let's go through it, because let's go through the taxable and tax-free components and how they can impact your estate planning over time. All right, there's a fair bit to go through. Here's sheet 1, and I'll get into sheet 2 a little bit later. But if I go down, what I'm going through here is I'm going to make an assumption that there is a super fund in play for $600,000 currently. One of the options would be to use that current super fund and increase it from $600,000 to $720,000. And then over here on the right-hand side is opening super account 2 with $120,000 in it. So the first thing we need to speak to is everyone's super fund has a tax-free amount and a taxable amount, or otherwise known as components. And when we look at it here, one thing that's really important here is in the makeup of this fund, 16.66% of the fund is tax-free and 83.34% is taxable. So if we went option 1, which is contribute $120,000 over into the existing fund, what you would end up with is the $120,000 goes straight into the tax-free, the taxable remains unchanged, but what it does is it changes these percentage proportions. And this is really important for a future planning if you're intending to do what's called a cash out and recontribution strategy. So if we go over here, if we put the money into the 720 account and we subsequently withdraw $120,000, it comes out proportionately. So of the $120,000, 30.55% or $36,660 comes out tax-free, and $83,340 comes out as the taxable component. We then recontribute that back into this super fund, and the way it will end up looking is it'll end up being $303,000 in tax-free, $416,000 in taxable. You've still got your $720,000. The alternate option would be, as mentioned, if we're putting $120,000 just into the account over here, we open account number 2, it's once again, it goes in as tax-free. But coming back to the future planning, if you withdraw $120,000 from the $600,000 account, the way it comes out is as per the old percentage proportions, which is 16.66 or 19,952, and 100,008 in the taxable. So then the future makeup of this account would be, when you take out 120 grand, you'll have 80,000 tax-free and 399 odd thousand in taxable for a total of 480. Then if we subsequently contributed that additional 120,000 back into account 2, it's got $240,000 of tax-free. Now that's a lot of information. Let me go to the summary. So now if we go to the summary sheet, what I've done here is I've summarized account using the current fund only, and you can see there, 303,000 tax-free, 416 taxable. Now, if we use the 2 other accounts, being the current fund and fund 2, you can see there I've added up the tax-free components for the 2, and what we have is a total of 320,000 tax-free when we use the 2 accounts, and nearly $400,000 taxable. So what's the summary of all of that? The current fund, we've been through that previously, 303 and 416. The 2 fund option is 320,000 tax-free and nearly $400,000 taxable. So the difference in utilizing this strategy and isolating this other fund is you will have $16,668 more in tax-free, and subsequently there's the same amount that's going to be reduced in the taxable component. So that's a pretty detailed explanation of taxable, tax-free, cash-out, recontribution strategies when you're considering future options to be able to get your tax-free component down even further with additional strategies such as that. Now, there's so much more to consider and so much more that you should be reaching out to a financial planner to have a conversation with them. And also a financial planner's office, unlike a super fund, is going to make sure it all gets done accurately, correctly, and within the rules. So if I'm a good fit for you, please give me a ring or book in a 15-minute chat with me, and happy to help you, happy to help anyone on this strategy. And you can see this is a good incremental improvement that happens when working with financial planners. Basically, the summary of this is $16,668 is the reduction in the tax-free component, and that's a potential future estate tax saving of $2,833. So as mentioned, reach out, schedule in a time, happy to help.